The good thing about the last few weeks is that we have seen the economy become the main topic of discussion. This is, I think, what we have always wanted to have a conversation around the economy. We were hoping that policymakers would begin to engage economists and engage the private sector. We're also hoping that Nigerians will begin to speak up, as everyone else does, on ideas that we think need to be given a chance and implemented, because we are in a crisis. And there is, after all, something called crisis economics. When the fiscal authorities and many people in private business said they wanted a lower rate of interest, I was concerned that the central bank would succumb to pressure. And the fact that the central bank did not says to me that the central bank is beginning to reclaim its independence, which is a very good thing for this economy. An interested party, as a former central banker, I can see exactly why the central bank was not willing to lower the rate of interest at this point in time. And let me try to explain this. If you lower MPR by 100, 200 basis points today, it is not going to lead to a rapid increase in credit growth. It's not. I mean, forget you will not see an increase in credit growth that will reverse a downward trend in output by lowering MPR by 100 or 200 basis points. You would, however, further fuel inflation, and you would reduce the yields on fixed income at a time when you're trying to attract foreign exchange. The immediate oxygen that this economy needs, because before you talk about the long-term structural issues of power and refinery, and I hear the chairman about investments, you do need foreign exchange coming into this economy. And the portfolio investors are important for that. And the way to do that, and the truth is, 2 or 3 MPCs ago, as far as I'm concerned, in terms of on paper, the central bank got the decisions right by saying, 1, we will go to a flexible exchange rate, and 2, we are tightening monetary policy. Now, what needs to improve is the improvement. Do we really have a flexible exchange rate? That is what we need to look at. Okay? And if we make those improvements, and these things require courage, because some of the decisions you would take when you say, let the market take decisions. So the decisions you would take would seem to fly in your face in the first week or 2. But look at the numbers, look at the fundamentals. The Naira today is undervalued, okay, if you take PPP. The Lagos stock market, you've looked at all the asset prices, PE ratios, you've got gross undervaluations. The fixed income is offering a high yield. So what does that tell you? If you allow people to actually come in with their dollars and sell at whatever rate people want to buy, people see that they're going to make huge profits on fixed income or on the equities market and on currency appreciation. And you have liquidity into the market. Now, so long as you don't allow that, you're not going to have the flows that you want. Now, it's the inflow of dollars into the economy that will move the Naira towards its fair value and get to where you want it to be. It is not by fiat. The market does not accept orders. You don't sit down and say, this is where I want the Naira to be. It will never happen. It has never happened. Achiampong tried it in Ghana. Okay, we've seen it in Venezuela. We saw it in Zimbabwe. If you don't have dollars in the system, your Naira is weak. Simple. So the question is, how do I attract dollars? Now, are portfolio investors the final solution? No, they're not. But, anyone who thinks that a long-term investor is going to take a 10-year, 15-year risk on an economy if the investor believes that we don't have short-term macro decisions right is wasting his time. You have to have the macro right. You're not going to have or the World Bank or the IMF lend money to you. You're not going to have banks invest in your bonds. You're not going to have people commit to 10 years, because at the end of the day, people are looking at this huge gap and saying, what is the chance that if I come in at this rate, I'm not going to take a very big hit if there is a devaluation going forward. So the good news is, if you look at the last 2-3 months, there has been a learning process. There has been a retracing of steps. What we need to do is understand what exactly is the macroeconomic framework within which we operate. What is it that we seek to achieve, and what theory advises what we're doing. So the central bank, for example, keeps high rates of interest, and it's very clear in its mind that it's keeping these rates up in order to keep yields high so as to attract dollars, and with that help stabilize the currency and improve liquidity, and with greater inflow of dollars, have more availability of dollars, and then more raw materials to, in other words, reverse, basically step by step, all the missteps that have been taken in the last 15-18 months, okay, and basically get capital back. And at this point, I think we need to understand that and encourage that, but we need to also encourage the central bank to have the courage to take that risk of implementing that document, actually going into that flexible rate. Let the market work for a week, 2-3 weeks, and see. As people find that they can come in, sell their dollars, buy stock, sell their dollars, buy fixed income, okay, make a profit on capital appreciation, make a profit on currency appreciation, you're going to have a gradual narrowing of the gap between the interbank and the parallel rate, and you're going to have more liquidity in that segment. This is my conviction. Again, we're in a very difficult moment, and difficult decisions have to be taken. So I'll give you an example. Government revenues have been hit very badly by decline in oil price. They've been hit very badly by the activity of Niger Delta Avengers, okay, and the reduction in output. The instinct of government, the instinct of fiscal authorities at this time is increase taxes. Get rid of incentives because you want to improve government revenue. Now, at this point, it's extremely important to look at the numbers. If you increase the tax rate, or if you remove certain incentives that have been given to private investment, how much are you going to raise? How many power plants will that build you? How many kilometers of road will you get? How many airports will you get for that money? 20, 30 billion, 40 billion, I don't know. On the other hand, if you decided to forego some of that income in the form of incentives, how much can you attract in private sector investment into those areas? Now, my sense is that you need to get away from a mindset where government raises money to build the roads, raises money to invest in agriculture, raises money to build airports, to a mindset where the government says, what kind of environment can I create? What kind of incentives can I create to allow private sector people to come and build this for us? And that's extremely important in terms of getting investment. And once it is clear that is the mindset you're working on, looking for private capital to come in and build your power plants, build your refineries, build your roads, build your railways, modernize your rail system, while you focus on public health, on education, on technical and vocational skills, on salaries, which have to be paid because you need to continue having your consumer spending anyway, then you begin to have a conversation that is fruitful, that is positive, and that everyone can relate to. So I suppose my word of caution is that in a time of crisis, you can panic and take a decision that looks very smart short term, but that hurts you long term. The decision to protect the nominal value of a currency was at the same time a decision to allow the real economy to take the hit, because it's a shock. That shock has to have a shock absorber. You either absorb it on, and this is macro theory, you either absorb it on a nominal variable or on a real variable. The decision to protect nominal variables meant that you took it on the real economy, plus you do not necessarily protect those nominal variables because inflation today is at 18%. We would not have been there if we had not made that attempt to protect that currency at that level. So the final point I'd like to make is, while we look at the missteps and the errors, it's always important to remember two things. First, there was something fundamentally wrong with the model of growth that we've had over the years. And this was the point I made in my discussion with the ministers of planning, which was missing in the newspaper headlines. Nigerian growth has been driven by two pillars, and this is true of many African countries in the last decade that was called Decade of Africa Rising. The first was